Welcome to another Market Insight Call where we sift through the noise to get to the signal, give you actionable advice so you can make informed decisions. Joining me this month, just like always, is Chris Ahrens. Actually, I should say Santa Claus Ahrens. And you called this one, and we're even celebrating it with the lights up here with green and red. Good call.
Yeah, it happens a lot. So, and we talked about it last year, that it happened then too. So it's not an out there call. Right? The signs were pointing there that it was likely going to continue as far as rallying into the end of the year. Still a couple trading days left.
Yes,
so there's still time for it to reverse a little bit, and we are getting a little bit long into the rally at least, which I'm jumping ahead of myself.
Great. Well, why don't we jump into it? Let's see what we're going to cover today.
Last call of the year, so we have to at least review 2023 at least a little bit, and that has to start with the Magnificent Seven. Largest 7 stocks in the S&P have really created a large concentration in the index, right, and also been strong returns, probably some justified. We'll talk about that as well. Buying market highs. Some of the indices just hit new highs domestically. International stocks are not at new highs. Small cap, mid cap. Bonds, certainly not at new highs. So a fully diversified portfolio is not going to be at new highs, but some of the indexes are. So we'll look at what happened historically when you would purchase at new highs. And markets rallied a lot. We'll have to look at our hub accounts for clients and distribution. Look at, should we set aside some extra cash right now? Interest rates are driving the market, so we'll hit on inflation and really close and really throughout talk about what we're doing for 2024. So one thing I really don't like the most about our job is pretending like something new happens just because the calendar changes. And we talk about seasonality, so there is something to seasonality certainly in the market. But this idea that there's this whole narrative shift just for the new calendar, I don't like that. Really, you name your title of your presentation, something's changing, the turning point. I know that's what LPL named theirs. Ours is really status quo. Right, keep doing the same things we've been doing that have worked. But let's get into that concentration.
Right.
It starts with in January of this year, the S&P 500 top 3 companies, Microsoft, Apple, and Amazon, were 14% of the index. So started pretty concentrated. The next 7 and the total top 10 were 26%. So we have a very concentrated index to start off the year. Not abnormal, that does happen in cap weighted, but it is certainly elevated.
I think one of the unusual things is whenever people talk about passive investing or typically index investing, low cost, one of the big premises is that it's diversification. Right? And the S&P 500 has certainly done well, a lot because of these stocks and that concentration, but you're kind of losing the whole point and the safety of passive investing, which is a diversified portfolio. So you're just grabbing the overall market exposure. You're still doing somewhat of that, but you're grabbing a lot of exposure, like you're saying here. Right. Not a bad thing, though.
A lot of risk, and at least on this year, the risk paid off.
Very much so.
When we're looking at the Magnificent Seven, that's that top line. Depends how you measure it. We have it over here at about 100% on the Magnificent Seven. Some of the stocks were up 200% over that, like NVIDIA, and then a little bit less for Apple and Microsoft. But significant rallies. So I've seen people measure this differently and say it's only up 80%. It's led the index.
80%. It's only 80%, huh?
Right. And so the rest of the index was up 26%, S&P 500. Global stocks were up 17. Right. So that's the lowest line there is a global portfolio. We, in our strategies, are trying to beat that global benchmark. And then we have a large cap stock strategy where we're trying to be right around that S&P 500, and we have been.
Both of those numbers really look similar whenever compared to that 100, but there's a big difference between 26 and 17%, right? The 26% being the best performing index in that global benchmark that you're talking about, where the global benchmark was almost 10% below what the S&P 500 did.
And we can look at what our global strategies did. So tax-wise, ETF, strategic ETF builder and signal, before fees, we're up 19 to 23% throughout the different strategies. Again, we were trying to beat that benchmark. That was 17 and some change. So it was a very successful year.
Right. And we spent a lot of the year very allocated towards that U.S. large cap. So we're closer to that best performing index than we are the benchmark, or between, I guess.
And when you look at the Magnificent Seven, the large companies, they have strong fundamentals. Their revenue growth is significantly higher than the index. Their profit margins, again, significantly higher than the index. Ends up having really strong returns on equity at the business level. A lot of our strategies are quality driven. generally the quality measure is returns on equity.
Right.
So we are going to have exposure to that. When we
Right.
look in our strategies and see holdings that are called quality growth in the ETF level, that's going to have some weight to those names.
And we hold, we hold all 7 of
Yep.
those names because of our broader, but we have positions, individual stock positions in those names as well.
Right. And we'll underweight some of them, like Tesla. We haven't had a stock allocation to Tesla individually. But when we say status quo for our outlook, well, we've been diversifying away from that. The concentration is really, really strong. Right. So when we're saying we still like large cap, we're still allocating there, just a little bit less. Right. And we look at what's happened really recently, and we've shown this chart several times throughout the year. So there's been this change where mega cap starts to underperform a little bit. So the chart here is equal weight. So instead of the strong concentration, all 500 stocks have the same weight. And the mega cap, which is going to significantly overweight that Magnificent Seven. In the last, part of the last month, this is a monthly chart, there's been a breakout and a broadening of markets. Something you've probably wanted to see for a while, but really it's something we've seen a few times, and it has not been a rally that's stuck. So this is just looking back at our benchmarks on each benchmark outside the S&P 500, using our signal that we use in our signal strategy and other strategies, as well as the center. Just how many times did you get a buy signal where this asset class is breaking out above the S&P 500? And then the trendiness, how long, what was the duration that lasted? And just looking at international markets, there's only one buy signal. It was at the beginning of the year, and the trend did not last very long. 5 months for developed markets and only 2 months for emerging. So there really weren't buy signals in those asset classes. Then the broadening out mid cap, small cap, there were 2 other times, so 3 overall, where they looked exactly like this last month, where you see the breakout of small and mid cap or the equal weight. They only lasted a month.
Right.
We're really right there again at 1 month of a breakout. So as far as broadening out, it's too early to say that those trends are going to continue. We think that they will, and there's good fundamental reasons for that. But as far as when we look at status quo, we're already allocated there. Right? We have long-term allocations to small cap value for long-term premiums that come in small cap value. So as far as adding to that, we're already there.
Right. So the big driver was the large concentration, large exposure to U.S. large cap, and avoiding some of these asset classes that have been only hot for a moment and drop back off. I'll let you take the next slide.
Yeah, which is just the periodic table of asset class returns. Same thing, looking at it slightly differently each year, which asset classes have performed well. You said it already, large cap, top right box, that's year to date, has had the highest performance. International developed has trailed that by over 10%. And then you have the U.S. mid and small starting to round that out slightly below. Again, sticking status quo, large cap, the dark blue tends to be towards the top.
Right.
At least the last 10 years. It has been there. We're not making a large call to say that that's going to change anytime soon. Right? We still are allocating significant parts of the portfolio to large cap. But as part of status quo, what else makes a lot of sense to us? Well, diversify a little bit in terms of rebalance. Right? Fixed income is paying a good yield. We're looking, if this rally continues, trim equities a little bit, buy a little fixed income when we're above. That's something we'll use discretion over and do as we see fit, and really start to look at adding to hub accounts, which we'll talk about shortly.
A lot of people, whenever they're constructing portfolios, they like to take the Chicago schools research and say, well, there's a premium if you have value, there's a premium if you have small cap. I know whenever we're doing analysis of accounts coming in, as somebody's becoming a client, we see that often. What should we be thinking about whenever we're looking at a portfolio right now on that value, that small cap tilt?
Yeah, so starting with just allocation geography, the S&P 500 on this chart is, out of developed markets, our highest expected earnings growth. That's the chart all the way to the far left. Then the next 4 bars are all developed international economies where the growth rate is much lower. Then we move to emerging markets, always has a higher growth rate.
Right.
It's in the emerging market space. You end up getting some issues. 30% of that is in China, right? So you do have a exposure to very volatile markets. And then finally, all the way to the far right, S&P 600, that's small cap, which you're referencing. Very similar expected growth rate to the S&P 500, so large cap. So if we're getting that scenario, that soft landing scenario, interest rates evolve to be coming down a little bit, then you're going to see strong small cap returns, which is what you're referencing,
Right.
which is where we're already allocated, and the plan would be to add a little bit more.
So we're already a little heavy on growth, and we want to pull that back. We think small cap has that premium. It looks good. It's U.S. domestic market. It looks like the U.S. market is going to do better, especially on a risk-adjusted standpoint. But value, it has some issues because we are likely to be going into an environment where interest rates are starting to decrease. And I know we talked about that a lot throughout the year, that growth is going to struggle in years where interest rates are going to go up. We've seen the market sell off as interest rates went up. Now it seems we're going to reverse course. So I would be more inclined to allocate towards the small cap premium versus trying to reduce our growth to just go value in that scenario. So I think that small cap makes a lot of sense. I still would be a little bit concerned on over allocating to value at this point.
Yeah, and just to really close out the status quo is really just with staying invested. Very unrealistic chart, gets quoted all the time though, so I'm going to quote it here too. What happens if you were in the S&P 500 and you somehow missed the 5 best days? You had that bottom graph, which is only 12% versus the index, 24%. We're quoting different numbers in the 20s depending on when the chart was run. So you got about half the return if you had missed those strong days. So just important, staying invested. And really just to close out the concentration, well, we talked about how strong those returns have been. Instead of 14% in the top 3 holdings, now it's 18%. Instead of 26% in the top 10, 33%. And there were some name changes in there too. Broadcom's now in the top 10. Exxon got reduced as energy has underperformed. So sticking with status quo, well, we've already been reducing some of that exposure.
Right.
The risk is just getting a little high.
And to your point, we're seeing those equal weight of those smaller names go up. So we should be getting a little bit more diversification by taking some of that concentration off and hopefully a potential higher return on top of it.
Exactly. So the Dow hit a new high last week. So we pulled this chart from technician Ryan Dietrich, and he looked at the Dow looking back 100 years, every time the Dow hit a new high, about 1,400 times in the chart blocked off in the red box to the right, and the signal dates. That's every time there's a new high. Happened 1,400 times roughly, and then he looked out, well, what was happening 12 months in the future? Returns were out on average about 8%, similar to long run average return, and percent of time positive, 70%. Again, we talk about how the upward bias in the market, the trend in the market is somewhere around 70%, excuse me. It's no different here, at least when he checked to see all-time highs in the Dow. So the trend really was very similar even when you're already at all-time highs.
That makes sense. And the idea is that markets trend upwards, so most of the time they should be near all-time highs.
Right. But the prudent thing to do when you're getting near all-time highs, for those that need to pull cash from the portfolio, is to start setting some cash aside.
Absolutely.
The last time we did that, complicated looking chart, just the S&P 500. The last time we did that was in August, where we raised cash. We set aside 18 months of cash for clients and distribution. The market was at a relative high for the year at that point. It was a good call because the next few months were extremely volatile. It was a seasonality call that this year in the market seasonality was magnified. It was very similar to what you'd expect historically, plus a little magnification. And that's exactly what we've been seeing recently. Now we've broken out to new highs for the year, and cash has been spent down the last few months. And we're down to 14, 15 months. And we think it makes a lot of sense to fill the cash hubs back to 21 months. And what your favorite chart?
Yes.
You want to take your favorite chart?
Well, yeah, I do love it because it's just saying, well, what's the long-term trend of the market, and how do we look whenever we do that? And we create channels to say, well, this is kind of where it tops out, and anything above that red line would be, well, it's actually above its trend significantly, and then below it doesn't happen as often, but you can see that it's below its long-term trend. So we expect that market to constantly follow that middle dotted line long-term. Well, when we're above that red line, that's when we want to raise cash and fill those cash buckets because we're ahead. Now that doesn't mean that we have called the top and that the market can't go higher. I mean, you spent a lot of time above the trend line not so long ago, but you want to fill those cash buckets, and we want to do it incrementally. So maybe instead of filling the 3 months. We're doing 3 months plus an extra 3. So that's how we're starting to get to that 21-month target, because we're once again above that trend line by a wide margin. Now, why not just do the 24 months? It would be great, especially since this upcoming year is an election year. 100% of the people are going to be nervous, and 50% of those people are going to be right or wrong after the election. But it looks like the Fed is going to pivot, whether that's a political move or not. Typically, when a president is getting reelected, interest rates do come down, and the market does respond to that. I think that's going to be the case here. I don't think we're going to have a big sell-off. You certainly will have January, most likely, whenever we look back historically, as a strong month. So we'll continue to raise cash so that the goal, if the market participates and we can stay above this trend line, just be going into the election with that full 24-month target. But we can see here, we're above trend. The market has moved a lot since our last call. Well, let's raise some cash, set that aside for the next few months so it doesn't matter where the market's going. You don't have to sell because we've already set that cash aside. Yeah. And then we could also talk about, well, what if we were to have a sell-off? Well, if we have 21, 24 months and we get deep underneath that line, well, that gives us the ability to add some of our fixed income back to equity, kind of rebalance and take some risk on. Or if you're not needing the cash, maybe even redeploy that cash to take advantage of those opportunities. So we love this chart. It's simple. It's easy. It doesn't help us time any tops, but it does help us take a prudent approach to that cash management and those cash up processes.
Yeah, that makes a lot of sense. You talked about also, alternatively, talking about the returns you can get in cash. Still a real yield. If inflation's coming in the 2 to 3%, at least on the PCE, we know people are feeling a little bit higher than that, and cash rates are coming in around still at 5%.
Right.
And you talked about the Fed's planning to cut rates. We'll show that slide in a second. But at least now, cash rates, where you have reinvestment risk, of course, is still in the 5% range.
Right.
We expect it to go down to lower, closer to 4.5 over the next year, and then again 3.5, 2.5. That's what the Fed is saying they're going to be doing. But you still get a cash yield over 3% expected over the next 2 years, and you're putting aside 21 months of cash.
Yeah, no, I think that's a great point, because most of the time that I've been doing this, you didn't get paid on cash, and we would just hold it in a brokerage account because there was really no way to get yield. You couldn't get yield anywhere. You're no longer losing the ability, because remember, we're assuming 5-6% long-term growth, and we're getting 3 and 4 on the cash set aside. We're still earning there and allowing us to take greater risk in your portfolio, because we can weather those downturns better with that cash. So it's definitely a different environment, and as the yield curve begins to change and steepen, which I think will happen in 2024, those cash the cash strategy that we have for advisory accounts is going to look a lot more attractive than it does on the money rates, where you can go buy a treasury at, well, I guess you can't now, but you were being able to buy them at 5%.
Yeah. So let's talk about the interest rates and what's happening on the short end. So in this chart here, we've showed this exact chart. It's starting to look even better if you were to look back to where it was the past few months. That's because the inflation trend is still coming down. So those numbers, the 3.99 and the 3.14 on CPI with core and headline, are continuing to trend down. We had a Fed meeting last week where they acknowledged that with the rates at 5.3 and this trend significantly lower, they don't think they need to continue to keep rates there if inflation continues to follow that path downward. And that's really what you referenced, which was the Fed pivot, which is in their forecast. They're saying, well, we think we can probably cut rates 3 times next year. So that's 75 basis points of cuts. Complicated looking chart, but just comparing what the Fed said and what futures markets, the CME futures, what traders are saying is actually, they're saying there's probably going to be 150 basis points of cuts next year. The one thing we know from looking at this is the Fed has underestimated the action that they were going to take. Right? They said they were only going to raise rates a little bit. Well, they went on the fastest hiking cycle they've ever gone on. So will we expect them to be a little more magnified? Probably. We're in there with Barclays saying that probably 100 basis points of cuts, conditional statement, condition that inflation keeps coming down the way that it has. And then, of course, other people are saying there are going to be significantly more rate cuts, whether that's a recession call, or Goldman Sachs says only 50 basis points of rate cuts. So there's a lot of different calls out there, and this is really the pricing of what will probably have a big effect on the market. Of if this doesn't happen, the Fed keeps rates tight, I think there's an inflation scare, we're going to be happy we've been setting aside some cash.
I mean, I think all year is about the interest rate and how it's had an effect on the price of the market. And that would be the reason that we're saying if we expect 100 basis points decrease in the interest rate, that's why we wouldn't want to go to value. Growth is going to have a much better position whenever you just price those stocks, as they're going to go up more than the value. And I think that's the most likely scenario. One, the Fed is saying they're going to do it. Two, the inflation is decreasing, and I get frustrated whenever they say inflation's down. And the value of things is going up less fast, right? It's just like they're still going up. It's still a 3 to 4% increase. But I think just stabilizing, to your point, is all that we need to see for them to start justifying bringing those interest rates down. It doesn't have to continue to slow and decrease. It just has to stay here, and they'll be looking to raise it or to lower interest rates.
Yeah, a good point coming into the next year is you're saying, we like growth, we like core. Some values a little underweight. Well, right now we're planning to have Jeremy Schwartz from Wisdom Tree on, who's really a value tilted manager. Right? He created a lot of the indexes that we use within our Wisdom Tree funds, which do tend to have a value or quality tilt. Just depends. He likes some of the dividend screens. We'll bring him on for a different perspective around that. But in terms of his overall perspective, we brought him in last January. Fantastic calls. He was one of the few analysts that predicted the rally of this year. If we went back to January, we were pessimistic. Right? We were a little late to the rally. We did catch up. We had a strong year, but in January we were a little bit too defensive. And he came in here and said, no, this year in 2023 looked like a soft landing. And he was one of the few people that made that call. So I think it makes a lot of sense. We'll bring him back on next month and have similar conversation for what 2024
Well, I mean, the headlines are still the same, right? There's a lot of pessimism in the market, and we can talk about all the technicals and all the different ways of doing it. I think an adage of the market's looking to punish as most people as possible always comes true. If everyone is expecting a recession, the market's just going to grind higher because that's the way the market works. Yeah. All that pessimism is getting priced in. That means it has nowhere to go but up.
Yeah. And a lot of that pessimism was money supply in the yield curve. So I figured we'd just close with those two slides. This first one here being money supply, top panel, just total money supply.
Right.
We see that decrease on the far right side the last year. And that rate year over year change in that growth rate on the bottom, which we see as negative and hasn't happened the last 60 years. There's never been a negative period. Generally, when it happens, you start to head towards recession. And that's what you're saying caught a lot of people and us at the beginning of the year.
Yeah, so the drop in the money supply certainly still keeps me up at night. But I think it's not an apples to apples comparison because yes, the money supply is decreasing over the last year or so, but 25% of all the money in circulation was created back there in 2020. I mean, look at how much it jumped up, and it's still trying to process its way through the economy. So that's money that's still trying to find places to go. Yes, interest rates are a little bit higher. Banks are not creating a lot of new loans out of that. But there are the amount of consumer spending, we're seeing it. There's still a lot of money from a COVID impact. And that's the reason that prices are high, right? The inflation is, we see that upward tick that looks like a hockey stick. It just takes off, and now it's finally rolling off. And now that the Fed is talking about bringing interest rates down, we're going to see that begin to mute, and we're going to start to see money supply likely grow, especially if the yield curve, the short-term money prices versus what you're getting paid to hold long-term debt. If all of a sudden that long-term debt pays more than the money prices, well, that's going to incentivize banks to make a lot more loans. So then we'll finally start to get this thing rolling and moving from there. And I think that's likely what will happen in 2024.
That's really what it takes for a next prolonged bull market that we've been talking about, is starting that new credit cycle.
Right.
And that's really what we'll be looking for to see, is this going to be a lasting rally?
We got anything else that we want to cover?
Everything I have for the year.
Well, we appreciate you joining us. Once again, check in next month while we have our special guest Jeremy on here to see what's going to happen in 2024, to see if he gives us an accurate call. I wish we could get the newspaper in 2025 so we could see what it is. If you enjoyed our Christmas lights, please go ahead and hit like and make sure you share it with your friends. And if you haven't hit subscribe yet, please subscribe so that you can be watching whenever I wear my seersucker. Chris gave me a lot of trouble because this is supposed to be a spring suit, but my red suit was in the cleaners. I'm preparing for next week. Happy holidays. We can't wait to see you next month.